So this is just a bit about the investment trust I run. But what I wanted to say is last year at this time, I did this presentation and I was really very optimistic for the outlook for investment companies. And it kind of worked out that way the first half of last year. But when we got to the autumn and a budget that didn't go down very well with the financial markets, and then subsequently, you've seen investment companies underperform quite a bit, actually, in the last 6 or 9 months. So I think it's got to the stage where you really are getting some outstanding opportunities in terms of the valuation of investment companies in relation to the prospects that they've got ahead of them. So that's a bit about the managed portfolio trust. So this chart here is an interesting one for you. It's the investment company sector against the all-share index. And there's a simple way to read this. When the line is rising, the investment companies are outperforming the all-share index, and the reverse when it's falling. So this is for 15 years. So that's a pretty decent time frame. And you can see from 2010 right through to early 2020, just before COVID, you had a small but very steady outperformance of investment companies, roughly 20 points better than the all-share over that decade, which is pretty useful performance. You then had a fantastic run in 2020 when we were all imprisoned in our homes, and a lot of the technology and growth stuff went off to the moon. And then you can maybe see here, at the end of 2021, interest rates started moving up, having had basically 12, 14 years of interest rates of 0.1%. So interest rates started moving up. The Russia-Ukraine war in February 2022, and inflation took off. And you can see rising interest rates, rising inflation, and the worries of recession. And oops, investment companies started underperforming significantly. And so just that last bit there, I've kind of concertinaed into this. This is the last 3 or 4 years. So you can see there from literally the end of 2021, and the worst underperformance was in 22 and 23. And then I thought the first half of 2024 is looking more promising, but unfortunately they've sold off again in relation to the FTSE all-share. And so where are we with investment companies? And really, I say it's a once-in-a-generation opportunity, but there's a whole lot of headwinds that have happened. The sector's been unloved, and it's been out of favour. Discounts, and I'm going to talk about that quite a bit in the next couple of slides, but a discount or a premium, just for those that don't know investment companies, is traditionally the way you value any individual company. So if it's got 100 pence of net asset value, but 90 pence of share price value, you're on a discount of 10%. It might be 20% if you're at 80p, or it might be a 5% premium if you're at 105. So discounts moved out. But this point I need to explain to you, because I think it's not as well understood, and is one of the reasons why a lot of listed investment companies have not performed well. And what I mean by that is, most of the time of the last 30 or 40 years, medium-sized and smaller companies have done better in the London stock market. They've outperformed bigger companies. Kind of stands to reason. It's easier for a small company to double a £5 million profit than it is for Shell or Marks and Spencer's or something. But what we've seen in 2022 and 2023, and then again in 24, and actually the first quarter of this year, has been the very biggest companies leading the market. And so what does that mean? If you're a fund manager, doesn't matter if you're an investment company manager, unit trust, pension fund, doesn't matter. You see Shell, that's 7% of the FTSE, or the Hong Kong and Shanghai Bank, that's 8% of the FTSE. If that starts outperforming, how do you get overweight if you're a manager of a sensibly diversified portfolio? Well, the answer is you can't, because you'd end up owning 10 or 12% of your fund in just one stock. So you've seen a lot of active fund managers underperforming their benchmarks. And that, of course, means, oh, well, why shouldn't you just have an indexed fund or an ETF? But that tends not to last for that long, and there have been reasons for it. If you look over the last 30 or 40 years, medium-sized and smaller companies have been the place to be. But that one has been why a lot of listed investment companies, and this has happened in the UK, it's happened in America, happened in Europe, they've been underperforming. Now, I'm not going to spend too long on cost disclosure. It's a very complicated issue, except investment companies have been forced, courtesy of some European legislation, to basically disclose their costs twice, which makes them seem a lot more expensive than other funds. And that, hopefully, is being addressed later this year through the FCA and, hopefully, an act of Parliament. But actually here, you see the traditional audience for investment companies has been private wealth managers. The likes of the Brewin Dolphins, the Rathbones, they're now huge. And they have been they've seen all this and they've decided they just don't want to know in terms of investment companies. And so for choice, they've been sellers. And that's not helped discounts. So here's one for you. Here's the average sector discount over the last 15 years. And you can see, you remember the last slide, basically 2010 to 2020, investment companies gently outperforming. Well, you see discounts, the average sector discount went from roughly 11 or 12 up to 2 it got to in 2020 and 2 again in 2021. But then you see the move, and I try and concertina this for you. The last 3 years, you've seen the average sector discount. Now, some are wider and some are narrower, but across the 300 or 400 listed investment companies has moved from almost 2 to, it got to 19 at the end of 2023. I thought things were improving in 24. We got to nearly 14, but we're back out again at 17 now. So that's why I'm saying I think this is a genuine opportunity, because I think some of that is looking in the rear view mirror. So let's look at some of the positives about an investment company. And just look at that top bullet point. Just remember, they can gear. Most of the time, stock markets rise. So gearing, a modest level of gearing, can be beneficial for performance. Other types of funds, unit trusts and OICs, they can't do that. Investment companies can invest in illiquid assets. So, for example, some of the Baillie Gifford trusts have got big holdings in SpaceX, Elon Musk's favorite company. It's a fantastic company. It's a satellite company. It's not listed. You'll not see that in an open-ended fund, but you will see it in a variety of different investment companies. You can get exposure to it there. And there's lots of different illiquid assets, some of them with lots of potential as well. Not subject to outflows. That can happen with unit trusts. You get inflows and outflows, which can make it difficult to manage. And lastly, and very importantly, you've got an independent board. So you've got strong corporate governance. So you can often see the board can change the manager. The board can reduce fees. The board can institute a program of share buybacks. Whole series of things which can be advantageous for the company. So don't underestimate these points. But let's look here. Historically wide discounts, well, they're as wide as they've been this century almost. Activists, yes, there's quite a few of them floating about just now. When you get wide discounts persisting for a number of years, that tends to bring in other funds who look to try and either acquire or force liquidation of investment companies. That can be good for share prices too, and it's happening at the moment. But through it all, retail investors, that's all of you and me and others, we've tended to keep increasing our shareholdings. The private wealth, multi-asset funds, they've been selling. but retail investors have been increasing their holdings. That's an interesting one. And performance, you notice most investment trust sectors tend to outperform over a decent period of time their open-ended equivalents. So all of this is me saying there's lots of value here, but you do need quite a bit of patience. And the other thing I would say, follow the money. Now, I visit lots of different fund managers, and it's quite interesting when it's somebody who runs an open-ended company and an investment company, I will ask them, do you have a shareholding? And you almost always, 99.7% of the time, all the money that they have will be in the investment company, not in the unit trust. Follow the money. So here's a little bit about the trust I run. And you can see here the long-term performance. We listed almost 17 years ago. Is actually not that exceptional now. I mean, the growth portfolio is slightly outperformed the all-share. The income portfolio is slightly behind. If you actually look at 5 years, it's really not very good at all. And that's that period. Do you remember when discounts were widening? Underperformed. And that's our last year to the end of December. The growth portfolio was almost in line. The income portfolio lagged. And this is actually, we're a May year end. So this is the 7 months to the end of December. And actually, the growth portfolio was showing signs of starting to outperform again. Let's hope so. But what I thought, this is a massive numbers, and I'll try and explain this to you. I just wanted to say this is a diversified portfolio of investment companies. If you look at 2012 and run your eyes along to the growth portfolio, -12, the all-share -8. If you then can run your eyes down the next 10 years, the growth portfolio outperformed every single year. And that was fantastic. And then we came to 2022 and 2023, and you saw very significant underperformance, which has brought us back to the level. So my point being is, in decent markets, this thing outperforms. Okay, just a word. I've got managed portfolio trust has 2 portfolios, got an income and a growth. And this is some of the details of the income portfolio for you. And you can see there it yields 6.8%. We've increased the dividend every year for the last 12 years. So we're now an AIC next generation dividend hero. But that's not bad dividend increases, and that's a huge yield you're getting just now. And these are just 2 brief charts for you. That's the share price of the income portfolio. We actually are one of the few that trade at a small premium. And that's because I'm ruthless on buybacks. If the market makers ever get left with any stock, we buy that off them. And we buy them even as tight as a 3 discount. So you're just never going to get a wide discount with this trust. And most of the time, the income trades at a small premium. And the growth, not far off it, we're at a 2 premium at the moment. So it can be done if the manager decides that they're not going to have a wide discount. You sometimes have to buy in a lot of shares, but it can be done. So here we go. Just a very brief one here. The key themes for the coming year. And I have to say, the top one has definitely not played out over the last 6 or 9 months. But I'm hopeful it might do as we move through the year. And it's just because the UK market is extremely cheap, particularly mid and small caps. And a lot depends on whether we do slump into recession or not. I think we'll know quite soon with the hikes in national insurance for corporations starting next week. But there are some green shoots there. You've had good data with retail sales. Employment is relatively full. Real wages are growing. I think as we move through this year, you might actually see the UK economy start to modestly improve. And that is a great background. Some of these trusts are selling at double-digit discounts. The underlying PE of the Aberforth portfolio is something like 8 or 9 times earnings. That's pretty cheap. And I think this one, the JP Morgan one, I seem to remember that's about 11 times earnings. So very inexpensive. But they haven't performed as yet. This is an area I think is very interesting, really wide discounts. I was at the Oakley Capital presentation. I think that's a fantastic trust. You're seeing net asset values beginning to start improving again. I think a better outlook for realizations, that's them selling some of their holdings at hopefully higher levels. And these are some great long-term performers. I mean, HG Capital, one of the best in the London stock market. And then I have an element within the growth portfolio in particular of ones with secular growth characteristics. And you can see there the technology trusts, which have actually been really poor in the last 3 months. But over the long term, they do tend to generate some strong performance. So just very briefly looking, that's the top 10 of the growth portfolio. You can see there you've got some UK equity funds. You've got some of the Scottish Mortgage, who are speaking along the way at the moment. But I like Scottish Mortgage. I've been adding to it over the past year. And the two technology trusts here. And that's a very interesting, they were also speaking today, the Aurora UK Alpha Fund. And that's the income portfolio, mainly UK and some global equity income funds there. You heard Mercantile presenting, that's a really interesting story. JP Morgan Global Growth and Income has been a fantastic trust in the last few years. And also, I like Temple Bar's done well, and just bought more of the JP Morgan European Fund, which is the top of the European peer group. So in the interest of time, I'm going to press past these, which are just what I've been buying and selling, just to say this is a summary of what this thing is about. It's a long-term savings vehicle for retail shareholders, private individuals. It's about 30 stocks in each portfolio that does tend to outperform in decent markets. You've not got any discount risk because I keep it pretty close to net asset value. And typically the growth portfolio is younger people prefer it. There's no income. It's all about capital growth. There hopefully is a bit of capital growth with this one, but you've got a 6.8% dividend yield, which is rising, which is not too bad at all. So just to wrap up, and I see I'm almost exactly on time, I put this up last year, and I'm putting it up again this year, because I did this data too quite recently. And it's just to remind you, and for me it's important, because, for example, the technology trusts have been horrible in the last 3 months. They've sold off really quite sharply. But that's when I bought these funds, and this is where you make many times your original investment. So the Allianz Technology Trust, despite being down about 20% in the last quarter, is a 10-bagger. Polar Cap Technology, nearly 8 times your money. That's just fantastic. Herald, 4 times the money. When I said it to the chap at Saba, we had a full and frank discussion, just disagreed on the fact that he was interested in trying to make an extra 10% on the discount and try and liquidate the trust. But despite its discount and not being particularly well marketed, it still made 4 times the money. And that's the more recent one. And that's a private equity trust that's mainly involved in software companies in Europe. Great performance. So at that level, I will stop 20 seconds over. How's that?